All right, well, I'm going to just start off by saying thanks for whoever is attending. There's a lot going on right now. We realize that. So the fact that you're here spending some time with us to listen to what we have to say, and hopefully you have some questions for us, really appreciate it. And if you're watching this later as a recording, thank you as well for spending the time. Real quick intro on me, and then I'll hand it off to Brian. My name is Megan Vandenberg. Everybody here calls me Meg, though, and I joined Painted Porch last fall. I'm one of the advisors here, and I live in Bend, Oregon with my husband. So that's the 20-second intro. Take it away, Brian.
All right, thanks, Meg. And just to follow up, Meg, Meg is running the host stuff here and also will chime in as an advisor in her own right. Dana's back behind the scenes, our head of operations, and may help us with some things behind the scenes. Most of you that know me well know I have no idea what I'm doing, and just want to make sure that expectations out there, technically, etc. I've got some notes here, so if you see me stare off to the side, it's probably because I'm looking for something or looking at a chat or something like that, so I apologize. This is our first time doing this, so bear with us. Really the biggest thing for us was to get out here and start the conversation, and like Meg said, really appreciate everyone coming and being part of it. We do, when we write a blog post or an email, it's really hard to figure out the balance between how long we make it and getting the point across. So we really do want this to be available for anyone that can benefit from it. So if you know people, you come away from this feeling like someone would benefit from it, feel free to let them know about it. And as you know, everything we do, this is all it's going to be, is a conversation. We're not going to follow up with them and push our wares on them in any way, shape, or form. So I think the other caveat just for me at the beginning, I know I have a tendency sometimes to get very technical. And so, when we get into financial questions, investment questions, financial planning questions, can be very specific, a little cold. Just want to acknowledge, with the coronavirus stuff, there's a lot of actual health and safety implications out there that are associated with some of the financial implications. And so we're never intending to be insensitive to that, just trying to focus on the finance stuff when it's a finance question, and the health and safety stuff if that's what we actually talk about. But just want to put that out there. So as far as Q&A, just looking at my question and answer. What are we doing now? What should we do? I think from our perspective, the hardest thing to do, and the thing we try to keep being diligent about, is keeping all the probabilities, all the possible outcomes in our minds and actually out in front of us. It's really easy to lock into even the most likely scenarios and assume that's what's going to happen on a given day. So if we think this is going to if the headlines are bad on the coronavirus stuff and we start thinking about the implications, it's easy to get kind of take that down a path and assume that is actually a most likely outcome. In my opinion, we're still in a world where the range of possible outcomes is really wide, and any particular outcome still has a relatively low probability. So for example, just as an illustration, we might have 10 different stories that could happen from today over the next 6 months, 12 months, 18 months. The most likely one might be a 15% probability, and the least likely one might be a 5% probability. Acting as if that 15% scenario is the only scenario is pretty dangerous. And there are so many unknowns that are just evolving every day that I think it's important to keep things on the table and keep thinking about all the possibilities. So that's from our perspective. All of us are in your shoes as well. We're all individuals with our own financial plans and our own financial pictures and our own concerns about those plans. And so what we're doing and what we think you should do is pretty much the same on that front. Feel very productive and optimistic at this point as far as like how this is all unfolding. These market environments tend to be very painful in some ways, but short-lived. and the recoveries can take, a reasonably long amount of time, 2, 3, 4 years sometimes. It's finite, and the recovery starts actually fairly soon. So this idea of what we're in the middle of now is not going to last forever. So how do we respond? First thing I had down really was to actually, we're pretty big on financial planning. So if you're in a position where a financial plan is either part of your picture or something that you've thought about, I think it's a great time to do it, or update it or revisit it, because it gives context to the whole question of what you should do right now. For a lot of people, just framing the financial plan again helps put in context even the losses in the market over the last couple of weeks. We're in an environment where inflation expectations have dropped almost 2/3, down to less than 1% inflation expected for the next 10 years. We were expecting almost 2% earlier in the year. And that has a substantial impact on those assumptions. A lot of implications like that are worth going through and figuring out, are you really in as bad a shape as you think you are right now, if that's even where your mind's at? Most people aren't. They're in much better shape than they think. We are rebalancing portfolios and think all people should. That's sort of a bias of ours, to be honest, that people should have balanced portfolios in the beginning. If you're 100% equities, then it's hard to rebalance. But we would say keep contributing to your 401k then, and just keep all those regular things happening that you were doing before. First of all, in the middle of a crisis, not the time to change strategies, but also there's just a really a lot of background historically that says if you rebalance through these periods, you do quite well. Main reason being that sometime in the next 5 years, these are going to look like really low levels. So if you have at least a 5-year time horizon, meaning you're going to live more than the next 5 years, chances are these will look like good investments. I think the biggest one, last one on this question, then I'll pause and see what we have on the board here, is try to avoid, and this goes back to the probability comment, like try to avoid all or nothing decisions. Try to avoid. It's really natural to get into it and say, should I be out of the market? Should I be in the market? Should I, do X or Y? And it's really a binary decision, because it feels like a very binary time. I think if you, to the degree you can, be aware of when you're trying to make a decision like that, and just entertain for a second what it would mean to intentionally get it half wrong. And the idea of intentionally getting it half wrong is really, I just viscerally still feel so unsatisfying that it's really notable. But what it means is that you didn't get it all wrong. By definition, if you get it half wrong, the other half can't be wrong. And so really taking note of those all or nothing decisions and kind of setting them aside for a minute. The last piece, which has nothing to do with finance, but I think applies to all the other pieces. Take care of yourself. And I don't just mean the health and safety around coronavirus. Like, this is stressful. We all deal with it differently. Some of us are contrarian. Some of us are, sort of in the mainstream in terms of how we respond, but it's stressful for everyone, even if we compartmentalize it. So, the basics of stress, get some sleep, get some exercise. I see a lot of things on the web now about these workouts that were developed in prisons and stuff, where it's like, really, if you're cooped up somewhere, you can get a really good workout. If you have access to nature without disregarding, all the safety measures, get out in nature. And then, like this, do things that are social, that are online. I think those all feed the human condition. That's all real touchy and feely, but I also, it is essential to making good decisions that you're centered and that you're reducing your stress level so you can be clear if you are making decisions in this environment. So we're doing all those things. I was commenting to the team, I just got my meditation in a little early today around noon, actually ahead of this and ahead of some other things. And man, it really helps get clear and centered. So I'll just pause there. That's what most I have on that. And I'm going to look at the question list and just see what we have up next. And if Megan, or if you see one that you think we should answer, I'm happy to jump on it.
Yeah, I mean, I think a natural jumping off point is, like, we've been getting a lot of questions from people about is now a good time to buy? So I think we should talk about that, because we personally, I've been asked that a bunch, and it's a really, it's not just an easy yes or no question.
Yeah, and and occasionally the opposite, right? I think we haven't got as many like, should I get out? Implied. I think a lot of people know they're not supposed to ask that, so they sort of, going back to our note that went out, they feel ashamed by saying, should I get out? But certainly, should I reduce is another one. So I'll go back to that last comment just about being half wrong and how unsatisfying it is. I think the hard thing for us to answer is, most likely 5 years from now, this is going to look like great prices for just about any asset you're going to buy. I think real estate's going to take a while to get cheap. Some other things are going to take a while, but certainly the stock market and the fixed income market, if you're not in treasuries, is starting to look cheap. But it can get a lot cheaper. So one of the things, and this goes to some of my answers on how long do you think this will last, is just to remind people, 07, 08 was pretty painful into early 09. That entire downturn took about 6 months to hit the bottom. Took about 4 years for the market to get all the way back to where it left. But S&P 500 at the bottom, actually when it started and when it came back out, was around 1,500. So here we are 12 years later, and we've just gone through a 30+% decline, and we're 50% plus above where we started in 08. 08, we went down almost 70% from the highs, 65% from the highs before we hit the bottom. So this can go down a lot more. That doesn't mean, again, going back to probabilities, I don't think it's the most probable case, but it's possible. And so really important to avoid buying in a brave contrarian moment, only to turn around and sell it, 15% lower, because it's painful and it feels like it's never going to end. The one consistent thing I've seen in markets like this, having been through two major Great Recession situations, is that the market has a really interesting way, because it's made up of human beings, of pushing to the absolute capitulation point. And that means a lot of contrarians actually have to get to the point where they're scared of the market. So my answer is a non-answer, as most people that have been in the market long enough get used to giving. But it is, to be measured in whatever you do. And I would say, whether you're thinking about reducing stock exposure or increasing it, just making sure it's something that fits with your plan and that you can withstand the implied volatility. So stocks from here, completely reasonable to think we'd go down another 30 or 50% in a 2008 scenario from here. Again, I don't think that's likely, and I can explain why I don't think it's likely, but it is possible. And so we need to be prepared for that.
Yeah, and I'll just chime in too. One of the big things that I've been telling people is, yeah, it seems tempting right now to take whatever cash savings you have and dump it into the market. But if we are really heading into a recession, which it certainly kind of feels that way, looks that way, you don't want to be compromising yourself if you lose a job or you're not able to work as many hours, those types of things. So make sure that you've got a healthy safety net, and try to be really disciplined about not just touching that and dumping it all into the market. So I think that's good warning. Yeah, Brian, if you could talk about why you think we might not see it go down as much as we did previously, that'd be kind of interesting.
Yeah, and caveat that, of course, we don't know.
Yeah.
I don't have any special knowledge. As we sit here and watch things unfold, I think it's interesting, this current environment. I think the consensus is, and I think it's correct, that we're going to get more bad news over the next 4 to 6 weeks, as the virus manifests in the United States. We don't know how much that's going to be, but it's certainly be more than we've seen yet, because there was plenty of infection that happened before symptoms were knowable. And so I think there were already plenty of people infected before we started the social distancing that we've undertaken as a country. So that's going to be bad news. I think the second wave of bad news is going to be the actual economic implications for small businesses and individuals. Those are all real. They're going to be a fairly short-lived phenomenon. I think it'll be in the next 6 to 8 weeks. Some arguments could go out to 10 or 12 weeks, but I think that's a pretty finite period of time. And judging from what we're getting out of China and some other places that were early, there's also a finite period of adapting to the new reality and getting through the first wave of infection. So those are all actually finite. It's not like we're sitting here saying it might be 4 years before we really know what coronavirus's impact is going to be on the economy. It's going to be a fairly short amount of time. Remember a couple different things. Human beings are very adaptable, and even with consistent negative news flow, we will adjust to consistent negative news flow. And then it will become normal, and then we'll start focusing on the change. So we don't actually need negative news flow to stop. We just need to stop accelerating. And then we'll start thinking productively. The second thing is, I think right now, first of all, I think earlier this week was the first time we had real signs of capitulation, meaning high volume, real fear, not just oh, this is a nice recession, we'll just go through this nice recession, we'll be out. I think people are really getting concerned. That is really healthy. But when I look at the actual implications, the long-term damage that we may do to the economy, I think it's important to keep in mind that all of it is optional, right? So when we talk about people being out of work, not being able to pay rent, small business bankruptcies, banking problems, those are all because we're a capitalist society with contract law. Not to get really nerdy, but the government has a lot of power to say, we're not doing any of that for 6 months. It is in everyone's best interest, if this is a temporary disruption, to have it be temporary and not have it cause all this collateral damage. And most of the collateral damage is covenants on loans, rent being due, utilities being due when someone's out of work, giving a chance for people to go back to work. So all the small businesses that will have to shut, they all rent place from landlords. Those will be vacancies. If everyone doesn't want to go through a cycle of replenishing the economy, it can actually get decided. One of the other questions we just had was the measures that have gone in so far since we're on it. I think a lot of them are just to buy time. And I think ultimately we need to end up with something like the savings and loan crisis had a workout vehicle. We had TARP for the banks in 2008. I think this will be something much more about creating leniency around long-term consequences of what is a temporary disruption for both individuals, small business, and communities. But it's well within our power to do that. So I think it's important not to feel too fatalistic about all the things that are going to happen when we can decide not to enforce law. So.
Cool. Well said. Along that same, that question that you referenced, it's also asking about, what do we think about like the Fed cutting interest rates and things like that?
Those, like I said, I think those are all trickle down things. So I think they did them early because they're available and they're a tool that they had immediately at their disposal. But I think ultimately, I may just be not knowledgeable enough to see how it flows down to individual workers and small businesses, which is where I think we're going to see a serious hit. I don't know, most restaurants don't have 2 months of working capital in reserve. So, 6 weeks of social distancing is pretty much going to shut half the restaurants down. I know a lot are doing delivery, and a lot of the employees are finding other work thanks to Uber and places like that. And but that's not going to solve the problem. I think it does buy us some time. But what I've been encouraged by is just how much. I don't know how you guys feel about what's going on in your communities, but how business owners, community, government, individuals are all, immediately coming together to try and figure out how to ease the suffering and the damage. And I think we're going to see that all the way up to the top.
What if we switch gears a little bit and talk just maybe more about the self-care aspect of this all? One of the questions is, you know, maybe I'm freaking out, not me personally, but you know, maybe somebody's freaking out. They know they shouldn't be freaking out. What can they do to try to stay calm right now, specifically around the volatility that we've seen in the stock market? Maybe not so much. We're not public health experts, right? So we're not going to comment on that part of it. But when you're seeing your accounts go up and down, you know, what can people do to stay calm through that?
Yeah, I think one of the hardest thing, and I obviously would love you to chime in on that too. I know you think a lot about it, but you know, the hardest thing that I was thinking about the other day with this particular downturn is that we're quarantined essentially. So you're put in a room with not much else to do but turn on the TV, and one of the best things you can do is not turn on that TV. And so, you know, finding other things to do. You know, for me, even in just the financial realm, and this is kind of walking the line of it, is really focusing on what we control and not taking action unless we know the action's positive. So, you know, again, these things are difficult as human beings. We have a bias to action, and it's hard to just not do something because we're not sure what to do. But I really think, if possible, you know, maybe get your news once a day in terms of the markets. It's volatile during the day, but it's not particularly helpful. Volatility from minute to minute. Yeah, take breaks and focus on, you know, I just saw, giving you a really long answer, just saw a speech, or actually a conversation with Daniel Kahneman, did Thinking Fast and Slow, psychologist, but won the Nobel Prize in economics. And one little segment of that was that intuition's like really, really valuable in making decisions, but only after you get data. So I think, you know, when you get stressed about the market, the best thing to do is to go look at, and we'll be putting out something over the weekend, maybe on Monday, just with some of the market history and the charts, but go get the data and say, you know, how long do these things really last? And yes, this time can always be different, but it tends to have some similarities. And, you know, what does that mean for me? If this lasts 3 to 4 years, from now to bottom to back above water, how much of that money am I actually taking out?
Mm-hmm.
How much can I afford to turn off the TV, wait a month, and then turn the TV back on and see where it is? You know, what we've seen, and there's a lot of different data, whether it be 401ks, other investments, where people set it and forget it, and they go through multiple market cycles that at the time feel just as violent as this one, and come out and they have among the top, you know, 5% returns of their whole, you know, peer group. And it's just because they didn't ever do anything. They just forgot about it. So it's easy to say, and I'm sensitive to the fact that a lot of people in the industry are saying you should do this, and it's kind of a short article on like, hey, don't listen to your emotions, just go stick with the plan and do what you're doing. And I know that ultimately that's what we're saying because it works. But the last part that I miss is probably just actually find a way to acknowledge that you're freaking out a little bit, and don't try to fight it too much. Like we said in our note, I think whether that's a journal or some way to get it out, just put your fears down so they get out, because if not, they fester. So I'll stop there. And Megan, I'm sure you have some ideas too.
Yeah, I mean, for me, it's more about the phone, right? Like I'm constantly drawn to be checking my phone. So putting rules in place for myself, you know, for that has been helpful. And I know I've talked to a lot of other people who are doing the same thing. Yeah, I mean, having a hobby is really healthy. You know, that doesn't involve screen time. I think also just knowing that we as a people have come out of these situations before many, many, many times. And during those situations, we always you know, I mean, you can talk to your family members who are older than you and experienced more things maybe than you have, but, you know, just knowing that we've felt like we've seen the end of days come many times. And it turned out that, you know, we are smart, adaptable human beings, and life moves on, things change. Definitely things are lost during those periods of time, and it's really sad and terrible. But in general, we've been able to come back from these things stronger. So I keep trying to remember that. And we touched a little bit on meditation earlier. Brian, you mentioned that you meditated before coming on here. Man, that stuff works, you know, so give it a try or try something similar, but that has been helping. We've actually touched on almost all the questions, I think.
You did.
One of the last ones is, can you talk a little bit about rebalancing? Maybe just give a brief rebalancing 101 overview and talk about why that works, specifically right now during a time like this.
Yeah, I think there's a lot in that, and we can get pretty nerdy about it. But I you know, ultimately the concept of rebalancing, we always use a simple example of if you were, you know, 50% stocks and 50% bonds, and you go through a market like this, we're down 30%. That means the stocks just went down to 35%, and 35 versus 50. I'm always bad with math off the top of my head. So 35 on 85, it's down to 45%, 40%, let's say, of equities. You know, to get back to 50%, you'd buy enough stocks to get back to half the account. So you get up to 42.5 of the original, whatever. But you buy a little bit of stocks. It's not a market call, you know, and I think the thing to remember is, you know, I had good conversations with a friend that was trying to figure out had some money on the side. I was trying to figure out when to come in. And, you know, the market is really good at pricing these probabilities and outcomes minute to minute. And so any minute we go and look at, should I buy stocks today? The answer is it's priced for just about the right amount relative to how scared I am to buy stocks. You know, it's like I'm this scared and the price is perfect for how scared I am. And I can't decide, should I buy it or not? If it was 20% cheaper, yeah, I'd be buying. And then when it gets to 20% cheaper, well, what made it drive 20% cheaper is really scary. So now I'm scared more and it's hard to buy. The rebalancing gives us a way to unplug from our emotions and just buy a little. It turns out, you know, that you see that chart a lot, that if you just miss the 10 best days in the market, you know, how much of the return you miss. Well, the corollary is actually true too. If you miss the 10 worst days, you'd be like that much better. You'd be like all the market gain is yours. The problem is historically those worst and best days tend to be really close to each other. So one of the best markets we had in the last 12 years was actually 2009, right after the bottom in 2008. But you had to be in the market, right? And you had to buy stocks. So when we went through 2008, that was about a 4-year period. If you rebalanced, our experience was it was less than 3. Now, when we're dealing 4 and 3 years, those both sound really bad, but I can promise you at year 3, everyone felt really, really happy to have been rebalancing and be back above water on their plan. And again, typically if they were in retirement, they're drawing 3 to 5% of their account. It really didn't have that much of an impact either way. But it's huge to be back in the positive. So the rebalancing is just a way to, in a disciplined way, buy a little bit when the market's down. And again, the corollary is true. If the market goes up 15, 20%, you know, next week, we'll be selling a little bit into that with the idea that we just can't get the timing right. So I don't know if I hit, Megan, what you thought we should hit there.
Yeah. Yeah, the tricky part is being disciplined about it, right?
Yeah.
So what's the joke? You buy some stocks, they go down a little bit more. You buy a little bit more, they go down more. You hate yourself a little bit, but you still buy more.
Yeah.
So
It's not easy. It's not easy. It's the market's a fascinating psychological experiment, if nothing else.
Mm-hmm. Yeah. All right, well, I think that's about it for the questions. I'm watching the comments too, and I haven't seen anything pop up in there. So I think we're,
I think if I have any other notes. No, I think, again, thanks everyone for being on. We know, this is a new system probably for everyone. If you had questions that didn't get answered or you just have follow-on questions, please feel free to send them to us. You can email us on the line. You can email us personally. And happy to do one-on-one time. Also, if you have a second and you have any feedback for us, what could be better, what could be worse, questions for our next one, we do plan on doing another one of these probably next week. Certainly regular enough that if, as things evolve, people feel like they have a place to come and talk. So feel free to come back for the next one. Again, if it's useful or you think it might be useful for friends, family, anyone, let them know about it. They're welcome. And I think that's it.
cool. Great, yeah, thanks everybody.
Thank you. Have a great day and be safe out there. Be well.